Good evening, the earlier speaker and the members attending this online webinar. Practical issues of accounting standards relating to financial closure with reference to AS 17 and AS 22. It's a very important topic as we are at the fag end of the financial year, and the financial closures are very vital for the financial statements to be prepared at the year end. So for this important webinar, in the absence of your chairman and our secretary, me, Pannaraj, vice chairman of the SIRC of ICAI, is here to welcome you all. A hearty welcome to you, Venkatesan sir, and also a hearty welcome to all the speakers. I take the pleasure of introducing the speaker before he takes over the presentation of his topic. Mr. Venkatesan M is a chartered accountant and is an information system auditor and a data scientist from Microsoft. He has led engagements in IFRS and data management from corporates for the last 7 years. He is a corporate trainer and has been associated with ICAI for various sessions in the past. And with this, I request the speaker to take over his deliberations on practical issues of accounting standards relating to financial closure.
Sir, thank you for your introduction. I hope people are in to see the screen.
Yes, sir. We can see your screen, sir.
I get some.
If you click on the PPT, it will come in the front side so that the videos go on the back.
Okay.
That's navigating.
I get some noise. I don't know what any.
No, it's muted. It's muted. No, it's not.
Yeah, sure. So I'll keep a couple of aspects open. Just give me a moment. I will also open an Excel so that we can deliberate and discuss certain aspects in detail, so that it will, I can navigate between these two screens in a much better
Yes, sir. Yes.
So now, thanks SIRC for the opportunity to discuss with the members on the issues associated with accounting standards, and especially with respect to two accounting standards that are by and large critical about which have significant impact in terms of financial closure and processes. So I'll use this session for next 1.5 hours to 2 hours about discussing the two accounting standards, AS 22 and AS 17, and what kind of practical issues that we would face in respect to these accounting standards, and what kind of calls that have been taken in the past by the professionals, and what we can take in terms of certain adjustments and etc. So first I'll go with the latest standard, which is AS 22, and then I'll come back to AS 17, because AS 17 with respect to segment reporting has shown the complications are a little bit on the lower side as compared to AS 22. So I'll use this with AS 22 as a primary topic of this particular discussion. So in now this, so I'll spend first 15-20 minutes about introducing the standard, presuming that there are certain newcomers who are slightly less aware about the standard. I'll spend some 30-40 minutes about discussing certain key issues about the standard, and I'll spend some time on discussing and elaborating about what kind of practical issues that I have faced in the past, and what kind of calls that we've taken, and what kind of calls that we have to take. And I would be open for certain questions with the members when they have certain questions that they feel that there are certain areas that they want certain kind of deliberations and discussions. I'll be open for that. So with that, I'll move here. So we all know it is it is mandatory for all companies, and it is applicable with respect to from 2006. So what is deferred tax all about? Why the standard is particularly introduced? What is the objective, or what is the fun behind introducing the standard in the primary element? Is that let us take a very simple rule of thumb on why the standard is introduced. In India and countries where they have an elaborate tax accounting system, where you have differential treatment for certain expenditures and income in accounting versus taxation, a common parlance between your accounting profit and tax profit is never established. So I'll go with a simple example. Let us take profit before tax of an entity is, let us say, 100, and if the tax rate of this country or this company is, let us say, at 20%, then the taxation charge should ideally be 20%. But by and large, what happens is that invariably this is never 20 on account of various reasons such as you have certain expenses allowed under your books which are not allowed under Income Tax Act or any taxation laws for that matter, and you will have income specifically as per taxation laws which are not part of your books of accounts, and you will have certain differential treatment on certain tax rates. Like for example, a very simple example is a capital gain tax. You will put the profit and account it in a different way in books and in with respect to your income tax, you account capital gain with a differential tax rate. So by and large, on account of aspects like that, where you have a differential treatment for expense income between your book profits and your taxation profits, we invariably end up with having a taxation number either more than what is the tax rate on the profit or less than it, depending on what kind of situation. So there was a requirement to understand why at all this particular number is different from 100. That is one. Second is, if this number is different from your tax rate on your book profit, there is a requirement to say, is this something that is reversed in the future and not reversed in the future? And assuming for a moment it is to be reversed in the future, it is an event that is occurring on account of current period which is going to get reversed in the future, and correspondingly we might have to provide for that particular charge or that particular credit in the financial statement during the current period itself. I'll go back to the drawing board on why such a thing is absolutely necessary. Okay, so let us try to understand it from the background info. So now let us say, now we have been discussing that there is a differential treatment between a particular item is held or treated in tax versus how the same item is treated in accounting. And if that difference between these two treatments for income or expenditure is causing you having a differential rate on tax with respect to your tax with respect to accounting, if that is a reversible difference, then we might have to provide for it. So the first primary question is why? Why not I just ignore this taxation itself? Why at all introduce a concept called deferred tax and account for it? Why can't we just go with whatever is the tax rate and apply it on the taxable profit, apply that and live with it? So I'll tell you a reason. Now let us say your profit before tax is 100 and your taxable profit is, let us say, 80. Now we all know that there could be certain differences between book profit and taxable profit. What would impact the deferred tax on it, what will not impact the deferred tax on it, is what we are going to discuss. But before we go any further on that, as we are now discussing the overall concept of the underlying concept, we will just park that particular line items which is causing the difference for a while and try to let us just assume that this 20 is a taxable profit and 100 is what is the book profit, and this differential of 20 taxable profit is less, and this differential of 20 is to be offered to tax at a later point in time. What kind of situations might occur here is, let us say, for example, you have let us say profit on sale of asset. It is at 20 and you have a differential tax regime in capital gain, or that particular asset is exempt. So it might be permanent, but you have certain reasons why you have a differential tax rate which is making your taxable profit less on account of depreciation, whatever. We will go into the details of it a little later, but let us assume that this is your difference and this is a reversible difference, that at a later point in time you might have to pay tax for it. So what happens is, now what is my, let us assume my tax rate is 20%. My tax is going to be on this, which is 16. So profit before tax, and this is my tax, or call it current tax, going to be 16. Assuming for a moment there is no concept of deferred tax, so your deferred tax is going to be 0 because there is no concept like that. Your profit after tax is 84. Now what happens is, you want to declare dividend for the current year, and just for a layman's imagination, let us assume that previous reserves are 0. Now the current profit and loss account addition is going to be 84. Now if you have to declare a dividend globally, so let us now first forget Indian concepts, because there are restrictions on how much dividend can be declared, all that. But let us now go to a global perspective, assuming that there is no limit on dividend declaration. Let us assume that I want to declare dividend for the entire amount. So what to which I can declare dividend? To the organizers, like, is the chat window open, or that people can respond in chat, or is it now held?
So they can respond it in question panel. I'll give you the organizer, right? So if they respond, they'll pop up. The questions will pop up. I'll just make you organizer.
Yeah, sure.
Actually, 1 minute. I made you organizer now, so there will be questions panel, right, where they can respond actually. If there is
so this is drawing room, analyzed,
right above the chat, questions, right, that can be popped up and popped in. So anyway, we'll see.
Okay, so now the chat window is also open. Okay, they can respond in any of this, or they can respond only.
No, they can respond only in questions panel actually. Okay, since it's a webinar, they'll be joining in browser also. So in app only they can respond in chat. So it's better they respond in question box itself. Most
okay. So now to a question here, what is the dividend that can be declared? So what can be declared as a, how much dividend can be declared out of this in this scenario? How much dividend can be declared? So anyone can respond to it. We saw a scenario. So how much dividend can be declared? Okay, so I can ask, I have to post a question, is it? Or by asking now people can respond?
No, by asking it out, they can hear it. But the response, there is 5 or 10 seconds delay post your completion. So there will be delay. Anyway, you can also post it. The question also can be.
84. So someone is saying that 84 is the way that they can declare dividend. Exactly. So I'll put it as 84. Now, at a later point in time, let us say we are going to the next year. Unfortunately, the company, I am just saying that this is completely hypothetical. Exactly the situation like this might not happen, but a near thereof, or a situation that is 50% or 60% of this can happen. Let us say we are talking about here too. Unfortunately, the company has not made any profits. Let us say this is 0. The taxable profits for the last year, which is reversible of 20, let us say it is getting reversed in the next year. It means I might have to pay tax on that 20 which is reversed, right? correct? Because next year there was no profit, but I had a claim in the last year that my taxable profit were less, and this 20 is reversible, and assuming that is getting reversed in the next year itself, so which means that my taxable profit is going to be in the range of around 20 and my tax on it is going to be 4. Now where does the money lie? I have a profit of 84 in the last year. I have paid that as an entirely as dividend, which means that I have completely distributed the entire profits, which means I don't have a known event that in future, which could be the next year or the year next, I know that there is going to be a taxability which I am aware currently, and that is arising on account of current year differences between accounting and taxation. But if I don't record that impact in my books, what would happen is, assuming I'm declaring dividend and taking away the profits, next year I might not have the adequate profits or adequate money to pay that particular taxation. So in this case, there's no money, right? In this case, there is no money for the entity to pay tax. So the concept of deferred tax is introduced in such a way that if there are issues on account of differences between accounting profit and taxation profit, and that is a reversible element, then we have to record for that eventuality in the first year itself. So now let us take the same example. Taxable profit is going to be 80 into 20. I am having a deferred tax which is going to be on this. This is permanent in nature, so I'm going to have that as a difference. And my taxable profit after tax is going to be only 0.4. From deferred tax, it has moved to current tax in the next year. So this will become, so I'll add 4 here and subtract 4 here because the deferred tax has become current tax. My profitability is 0. In this case, I will declare dividend to the tune of 80 in the first year, where I have earned 84. I have earned 84. I am having restricting myself because of the deferred tax impact only to 80. Next year, once this 4 rupee tax impact comes into picture, we have no problems in paying tax. Getting it? So the point of accounting for the differences between accounting profit and taxable profit, which are reversible in the future, is to ensure that because the impact is originating on account of the current year, number one. Second, that impact is expected to be reversed in the future. The third point is, to that extent, restricting the dividend distribution and the profitability will get reduced to that extent, so that you know and you're prepared for an eventuality of outflow of tax in the near future, because that is an event that is created on account of the current year and that would get reversed in the future. Fundamentally, this is the reason why deferred tax as a concept has been introduced in accounting. One is the matching principle, because the tax that they're going to pay in the future is not on account of the accounting profit generated of that period, but on account of the accounting profit generated in this period. So one is the matching concept. Second is ensuring that there is a reserve that is available by preventing dividend distributions and etc., so that the taxation that would happen in the future, because this is only for the temporary and you know that you're going to pay it back, is generally available with the company. I hope this actually explains why a particular accounting concept has been introduced. Now, having discussed this particular point, we'll go back to the drawing room on what is that kind of differences that might arise between income tax profit and accounting profit. So for that, we will start, discussing about certain terminologies. Oh, sorry. So I minimize this.
So, sorry.
Okay, I can minimize this by. Okay.
Yeah, there is option to in the webcam. It can be kept as not always in front. So only your PPT will be visible. You'll
So
be
the
able to
first
see.
point is on tax expenses. So tax expenses, which is defined in AS 22, is aggregate of current tax plus deferred tax charged or credited to profit and loss. So the concept being that you might have a tax charge, you might have a deferred tax charge, or you might have a deferred tax credit. Deferred tax credit is something that you generate on account of your deferred tax profitability that occurred in the past. Current tax is your amount of tax payable or recoverable in respect of taxable income. In currently in India, you don't have a recoverability of income tax. You just have a tax payable. You don't have a recoverability. You might have a MAT tax asset for which you have a tax credit. You will have a current tax, and you will create a corresponding impact in the MAT. But generally, it will not be a negative sign. Globally, that concept is possible where you have a set of, now in India, let us say you have a taxation of 20, and out of that, let us say your MAT credit is 10. So what would happen is profit would be 100, you will have a current tax of 20, and let us say you have a deferred tax of say 4, or this becomes 16 and this becomes 4. And let us say out of the current tax, your MAT entitlement credit, so it will be a less MAT credit, let us say 8. So what happens is that in India, the concept of this becoming a negative element, that the total of these two becoming a negative element is not, I've not seen such a case, and with that, we don't have such a case. If you have a loss, you just carry for the losses and you'll have a deferred tax. There is no concept of getting a refund from the government for the loss. So this will never become a recoverable. This number of 8 will never be a recoverable element. You might have a TDS impact, but that is a balance sheet item. But so you might not have a recoverability. At 4, you will have a you might have a negative also. You might have a deferred tax asset also. Let us say minus 10 is your loss, minus 100 is your loss. Then we might have a deferred tax asset to the tune of this. So which is a positive number. So now my net loss is not going to be 100, it will be 80. So you might have a recoverability in deferred tax, but you might not have a recoverability in current tax. So current tax is amount of income tax payable, recoverable, which is just conceptually in respect of taxable income for the period. Deferred tax is tax effect on timing differences. So when I say it is reversible in the future, the standard defines reversible elements as timing differences. Then we have something called accounting income or loss is net profit before deducting income tax or expenses, typically profit before tax. Taxable income is the tax that you determine the income or a loss for the period in line with the taxation law. So accounting income is the income that you generate in your profit and loss account. Taxable income is the income or the loss on which you have to suffer the taxation. So it is your accounting income plus or minuses whatever is the tax laws that are enacted. So now what is a timing difference? So before we go further, the differences here are 3 categories. One is expenses where it is allowed in books, not allowed in Income Tax Act. So vice versa, allowed in taxation and not allowed in books. The same way, income, it is only for taxation and only for books. And differential tax rate. So these are kind of differences that you might get between your accounting profit and your taxation profit. You have certain expenses that you have not allowing in Income Tax Act. You have certain incomes that you offer only to Income Tax Act. These are kind of differences that you might get between your accounting profit and tax profit. Now these differences actually is categorized into 2 categories. One, the differences that are originating in a 1 year and it is getting expected to be reversed in another year. It could be the next year, the year next, or etc. Those are called as timing differences because the difference is perfectly on the timing. It's get reversed in the timing. And the other differences are called as permanent differences, the differences that doesn't get reversed at all. So a typical example would be, let's take depreciation for that matter. So now let us say I have an asset which is 500 being the cost of the asset, and the cost of the asset assuming for the income tax and books remains the same. And for the purpose of books, which is my accounting, I take a period of 10 years and I'm doing an SLM. And for the purpose of Income Tax Act, I have to charge these in WDV, and let us say the useful life of these assets is going to be 15%. So here it is 10, so which means that it is 10% and it is 15. So now my residual value for this example, let us assume it is 0, and so my depreciation is going to be, let us say this is the years 1. So the book depreciation is, when they mean it is timing, it's going to be equally spread. And with respect to income tax, have so I'll preferably draw opening. So it goes on. We will increase this percentage to 20%. So I'll close it in a couple of more years. It's also 25. Okay. So 11, 12. Okay. So just for this example's take, let us assume that we write off this asset at this period, just to make it simple. So it is here 16%, or let us make it as 35 and check how does it flow. Okay, so here we'll write off at this level. So book depreciation is, it comes for 10 years and this comes for 13 years. So when we mean to say it is reversible in the future, what happens is, that you have in the first year your income tax depreciation is more, which means that you're paying less tax, and the next year also you pay. So from the third year it starts to flip provision, which means that you are going to pay more tax, and then you have a flip position at this level where you start paying less tax, and it eventually settle down at this. So if you are going to put a plot of graph here, it might be a U graph which has where values of differences here. So when we say it is a timing difference, it means that current year this 175 is allowed in the Income Tax Act, and in the books you are charging only 50. At a later point in time, you will have a period in which you will charge very less in income tax and you might charge more in book profit, and over the life of the years it will eventually become zero. So the difference will get offset between the financial years, and at a point in time it will become zero. This doesn't happen practically because you don't have a single asset and you don't appreciate, I mean, you don't do a depreciation on a single asset basis. So this will never get to our picture. So I have just plotted into a single asset to establish that how this is a timing difference. Because depreciation is something that quite often comes in every entity, and this difference is actually arising. So if on the difference, how it actually flows is that in a year I might have, I mean, cost this item costing me to pay more tax. In a later year, it will make me to pay less tax. And that in eventuality, if you look at, I would have paid the same amount of tax, but it is just that the time period at which this entire scheme of arrangement flows would have been little different. So that's the way this particular, item operates. So so that's why it's called as timing difference, because at the overall total of it is always zero. So which means that this difference is going to get cancelled out in the future, but it doesn't happen in the same financial year. So we call it as timing difference. Now let us take another example where, let us say, there is a penalty. So they have paid a penalty of ₹20. Now let us say my income as per books for year 1 is 100, and which includes that this penalty is paid. So income for books is going to be 100, and income for taxation is going to be 100 plus 20, which is 120. Now in the next year, can I claim this 20 rupee at any point in time? The answer is no. So which means that this is actually this difference. Let us call this A, let us call this B. A is timing in nature, B is permanent in nature. So the deferred taxes are required to be created only on this and not on this. So this is the fundamental concept on timing differences. Differences between taxable income and accounting income, which originates in one period and capable of reversal in one or subsequent period. So the term that is used as capable is that it need not eventually reverse also, because in the mid of the year you might sell that asset. So there is no requirement for you might not have it to be, charged off, or you might not need to set it off, but you might have to, um, uh, eventually it is capable of getting reversed in one or more subsequent periods. Some of the examples are, let us say you convert capital asset into a stock in trade. So that income between those two differential is accounted in the same year when there is a reversal happens, but you pay tax in 2 years. So the profit on capital gain is paid at capital gain that is originating at that time when the conversion happened is paid in one, and your stock in trade taxability, so the amount that is to be converted to tax is at two intervals, and you paid on eventual liquidation of that stock in trade. So but for books you might have to account it differently. So that is one. Second is where you have certain expenditure that is allowed only on payment basis under section 43B, and recognition of income spread over a number of years. For example, in the year of receipt, it's accounted in, we have to pay tax on a non-compete fee on a cash basis, but accounting happens over, if you have a non-compete fee for, let's say, 5 years, then you have to offer that particular fee on every period of that 5 years. Then T development allowances is allowed in 1 year itself on the deposit, but expenditure would be on account of that withdrawal or amortization of that particular deposit. These are some of the timing differences. Permanent differences is where certain expenditures not allowable inside the Income Tax Act in respect to certain research and scientific expenditure, where you allow more deduction in the Income Tax Act, but that deduction is not, weighted deduction is not allowable inside the books, where these differences are permanent in nature. With respect to those items of differences or categorization, there is no deferred tax that need to be created. It is only called as a permanent difference. So tax expense should comprise of both current tax and deferred tax. It is included at the time of determination of net profit for the period. Deferred tax is recognized for all timing differences. Prudence is one such effect on deferred taxes. So we'll discuss that particular point. Till now, I hope people are comfortable with this session. Is there Any comments now till now? Any questions for people? Anything specific? Oh,
No questions till now, and we'll.
okay. So, apart from this particular item on deferred taxes, certain practical aspects which we need to discuss it out at this juncture before we discuss certain unrecognized deferred taxes, and what is the standards on review of deferred taxes at each point in time, and etc. I thought it will be prudent for us to discuss certain element on recognition of deferred taxes at a very practical level. See, when we review balance sheets, we come across certain errors that are rudimentary in terms of these deferred tax recognition. So I'll just list on those and then elaborate on that. Number one, let us take property, plant and equipment, which is your fixed assets. Now, is deferred tax to be considered on differences between depreciation of each year, depreciation between IT Act and books, or it is to be created on the WDV value differentials? So there are two ways in which you can compute the differences. So we'll go back to this example on the asset. Okay. So now you have an asset which is having a carrying value as per Income Tax Act, or the WDV value as per Income Tax Act. The same asset will have a book value, so which will be 500, and it will be okay, end of year 1 it will be, I'll put it as year 0. 500. At the end of year 1 it will going to be, oh sorry, fair. Okay, so it gets eventually 0. Now the question in front of us is, am I going to create deferred tax at this level or at this level? Now, if I'm going to create using balance sheet, we are determining what should be the closing deferred tax asset or liability at that point, which means that I have paid less tax in the period, so I will have a deferred tax liability. So I will create deferred tax liability here, assuming that minuses are negative, which means that I will have a deferred tax liability because I am paying less tax because my depreciation is very high. Okay. So it has become 0 in this year, practically nothing. Now what happens is, this is the deferred tax liability closing balance. Now if I create here, if I'm doing a P&L approach, I might have the charge to P&L. Eventually it should all become 0. There's no doubt about it. I'm creating what is a charge to the P&L. I think didn't get 0 at a point in time. Asset get 0. Okay, certain area here it didn't work. Fair enough. Okay, it's not 500, is it? It is WDV of 35%. Okay, so coming back on this particular case, how I should prepare a deferred tax. So this is my charge to P&L. What is, according to the readers, better approach? In the first year, it will not have an eventual difference. In the second year, what would happen is that you will create impacts like this. So your charge to P&L will be different. But here your charge to P&L will be different. So here I am creating a closing deferred tax liability if I use WDV method. I am first determining what should be my charge to P&L if I use depreciation approach. This is called as income approach. This is called as asset approach. So what you think is the most appropriate thing? Any idea? What do you think would be most appropriate aspect to do? Any idea about it? What the users feel is the most appropriate thing? What do you think is the most appropriate way that which we can determine the deferred tax? Income or the balance sheet? So I think we can answer using questions window. So you can say whether it is income approach or you will use the asset approach. What you feel is more relevant or what you feel is more right? Asset approach. So one of the reasons, one of the person has said is asset approach. Any other alternative view? Any other alternative view? Okay. So now I'll tell you what is the intricate or an essential feature of these. When you go to the global standards doesn't allow this approach at all. So the corresponding parallel of Ind AS 12, which is our income tax standard, which is combination of both the deferred taxes and current tax standard, doesn't allow us to do anything on income approach. It allows only to do with asset approach. It is actually not doing anything on income approach. The AS22 is actually allowing both the approaches. It allows income approach and it also allows asset approach. But according to me, my personal view is it is good to adopt asset approach rather than adopting income approach. I'll tell you the reason behind it. Let us take a very simple, quick example. Let us take a WDV and let us take books. Opening, addition of asset, deletion of asset, closing. And what is the depreciation? Let us say the opening was 100, we have added 20 worth of asset, we have deleted. When it comes to income tax, the entire cash consideration is getting deleted. So which means that, let us say I have sold an asset from this 100 for 10 rupees, which is my consideration. So my closing is going to be on this. And I will have a depreciation, which is, let us say, minus 15. So my total balance is 95. Let us take for the books, my opening will not be equal to my WDV. Let us say the opening is 90. The additions will match. The deletions will not be 10 because I will have an eventual profit or loss or any item of that category. I would have removed. When I say books, I'm looking at the net value, not at the gross or at the accumulated depreciation value. I'm looking at the net value. When I have books, I would have deleted the entire asset. Ideally, what would happen is either I'll have a profit on asset or a loss on asset. So I will remove assets to the tune of whatever was there in the gross block, whatever was there in the accumulated depreciation. So ideal note is that it should be 0 when I remove that particular asset. Whatever at a net block level, you will not have a difference, but because you would have charged off with some depreciation, you might have an impact. Let us say that impact is 5. So current year also you would have charged some depreciation. Your accumulated depreciation balance might not be equal to the gross block as an asset. So let us say gross block was the asset that you're removing was 10, and the accumulated depreciation corresponding to that was 5. So which means that at a net block level you will be removing 5. Just for an hypothetical example, and let us say your depreciation is little bit on the higher side because the books is having a higher value. This is the depreciation. Now if I charge the deferred tax purely based on depreciation, I am completely ignoring the income approach. I am completely ignoring the impact of deletion, because I am going to compute deferred tax at this level. But if I compute it at this level, I am including the impact that deletion might have on the asset value. Right? This deletion will also impact, no? Eventually, this deletion would impact the depreciation as well in the later point in years. But the deletion happened in the current year, which would get missed if I'm using an income approach as against an asset approach. So ideally, I would look at deferred tax asset to be computed as differences between WDV closing and WDV books closing, and then start implementing those items. So now I will compute deferred tax on this, let us say at 25%. I will know what is my opening deferred tax. Let us say opening deferred tax is 100. Then my deferred tax for the period is 1 and not at 1.75. Clear on this? So according to me, an ideal approach is using only WDV or asset model rather than your income model. Certain mistakes that I have found in the past, what people have been doing is this differential, this deferred tax of 2 that you compute doesn't determine the charge that you should do to the P&L, but instead it gives you what should be the closing deferred tax liability or asset. What generally happens is that people charge this itself to P&L, which is not the criteria. Now let us say your opening is 1, opening deferred tax is 1. Your closing by WDV method, what you determine is what should be my closing, which is ideally 2. So the difference of 1 is my charge to P&L, or let us say this is 1.25, 1.50. Then 0.5 is something that I charge to P&L and not 2. So this we have to keep in mind when you're doing WDV approach. If you're following income approach for a while and we are changing to WDV approach, then this has to be kept in mind. So very fundamental item is we have to adopt at WDV level, which is what international standards are preferring. So we would be in line with our international item. Second, 43B impact. Practically, when you start computing your deferred tax computation, it is fundamentally required for us to look at the last year deferred tax item. I'll give you a reason behind it. There are different article assistants who prepare it. There are different managers who review it. So what eventually happens is that sometimes inadvertently a concept of deferred tax might be thought about, but people might miss impacting that inside the financial statement. Maybe on account of materiality, it might not be a big error. But what happens is, if you're creating a deferred tax reversal on account of 43B impact, it is very important that we go back to our earlier year computation and check whether on origination such asset was created. So I'll give you an example. Year 1. Let us say your taxable income, your book profit is 150. My taxable profit, assuming for a moment there is no depreciation impact, I want to emphasize on this particular point, 200, because you had certain 43B disallowance. Okay, we'll keep differential impact also. So I'll add back Companies Act depreciation. Let us take 10, and I'll subtract Income Tax Act depreciation. So 43B disallowance, let us say, is 40, and you had an income tax depreciation of 8. So your total income is 192. This is year 1. Now people have computed deferred tax. When they have computed deferred tax, assuming for a moment, they have computed using income approach. My book's depreciation is more than the income tax depreciation, which means that I would have paid less tax, and I would have paid more tax. So it will result in a deferred tax asset. So on this 2 rupees, I'm going to charge 25% as my deferred tax. So which is 0.5. Now we are in year 2. Assuming I don't have this particular item. Let us say I've forgotten it. My profit is 200. Now what I'll do is the bonuses and etc. has been paid in the subsequent year. 43B gets allowed now. Now Companies Act depreciation is 20 and Income Tax Act depreciation, let us say 16. There is no 43B disallowance in this current year. My 43B allowance is, let us say, so my taxable profit is going to be 174. Now when I have deferred tax asset computation, again my Companies Act profit is lesser than income tax profit, which means that I'll eventually have an asset. But this is the catch here. People see 43B allowance and they say that this is being allowed. That has to be subtracted for my deferred tax allowances because this is allowed in this current year. It is a temporary difference or a timing difference. They charge off this number also. Originally the deferred tax asset was 1. Now this will create a liability which is 0.5, right, which is allowed. And now 43B. So 0.75 is the reversal that I have. People will say that my deferred tax is 6.2 negative, which is resulting in a deferred tax liability. I have seen innumerable balance sheets when I had to review this particular item happening. Problem is, if they have applied and reviewed what has happened in year 1, they assume that for 40 they have not created a deferred tax asset on account of some reason. We should ideally be not creating a reversal, because if you see at a closing balance level, this is the 1 and 0.5, this is 1. So which means that my closing should be 1.5. But if you do this method, it will be 0.5 plus 1 minus 7.5, which is at 6. So we will reverse more than what we originally created, which is not the intent. I have created a disallowance in 1 year that will result in a deferred tax asset. I have to reverse that particular deferred tax asset in the next year when it gets reversed. What happens innumerably is that whenever they see a allowance, they don't look at what has happened in the past and they create a reversal of that which was actually not required. So we overkill. There is no allowance on which there is no disallowance on which deferred tax is created, but on allowance I reverse the deferred tax asset. That is not required. So because it is like a double time impact, that's an overkill. So very importantly, whenever you're doing a practical deferred tax computation, we should keep in mind that if we are doing any asset reversal on account of 43B or on account of any other item which you are getting reversed in a year, look at it, could be leave encashment, it could be on gratuity, because in leave encashment you allow in the books you do accounting as per actual valuation, but you might have to pay leave encashments to claim there is a benefit under the Income Tax Act. So the point that we have to consider is, when we are preparing our memorandum of computation for income tax or a statement of income computation for income tax, we will have allowances and disallowances. When we are creating deferred tax on any allowance that is originating on account of the previous year, it is fundamentally important for us to keep in mind that whether such originating asset has been created, and if it is not, then you need not reverse it and we need not do an overkill. So these are a couple of points that has to be kept in mind whenever we do deferred tax on account of these timing disallowances exactly originating from Income Tax Act and or profitability. So now what happens is there are two things that can happen in when we are computing a deferred tax. It could be an income, which is a deferred tax asset. It could be an expense, which is a deferred tax liability. Now, for whatever we create, whether it is a deferred tax asset or a deferred tax liability, there is a certain level of certainty. There is certain level of endurance that we have to keep in mind, is that this asset or liability has a probability that it will get reversed in the future. So assuming it is not going to be reversed in the future, or you feel it may not get reversed in the future, primarily creating a deferred tax asset or a liability itself will not serve as any purpose. But you have to apply even more prudence when we are creating something on account of deferred tax asset, which is even more important because it is actually increasing your profitability against your original accounting profits, which means that the opportunity to pay dividends and etc. are more when we have this particular asset in mind. So it means that it will increase your deferred tax, it will increase your profitability at a PAT level. So even more prudence is necessary. So what should be done? It is reasonably certain. So here there is a difference between income tax under Ind AS, which is Ind AS 12 versus AS 22. There they are talking about a certainty which is not reasonable certainty, which is not at a higher level of certainty. But here we are talking about reasonable certainty. What is a reasonable certainty? That there will be future taxable income will be available against which this deferred tax can be reversed. So now let us take an impact that this particular case of allowance on which we are creating a deferred tax asset in this case. Now let us say that we are doing it right. So which means that I will add what is my disallowance and charge deferred tax on it. And year 2, I will properly have reversed this particular element. So in year 1, when I do this particular computation, because I am creating a deferred tax asset, I have to be certain that this, it need not happen in year 2 itself, it can happen at year 3 or year 4, whatever. But the point that I have to keep in mind is I should be prudent enough to evaluate whether this asset will get recovered. Actually, deferred tax asset is not an asset that I carry on forever. It's not like a loan or a deposit and etc. It is an accounting asset or a liability that you create because of differences between the treatments of accounting and taxation, right? So which means that if this asset is recoverable, it is recoverable only by one way. That is, the deferred tax will become a current tax element, or it will reduce my current tax impact. There is no way it will become an asset of recoverability by way of cash, right? Deferred tax asset is an accounting entry where the reversal of a deferred tax would originate by reducing the impact on current taxes, because that will be the case, so that your overall tax element will become normal. So in our example here, let us say in this case, which was our first example, this 4 is eventually have become that it has become a current tax, so that your overall tax position, so we saw something as taxable taxation charge. Taxation charge is nothing but 16 year and 4 year, which is eventually 20. Here also it will be the same, right? So the taxation charge will be only the position where it will be a flip between a current tax and a deferred tax, because it reverses in the future. So which means that it is not an asset where you have a recoverability by way of a cash. Here it can translate to a current tax, and that's the only way it gets reversed, or it might reduce the deferred tax. Here I have created 4 and I'm subtracting 4, which means that I am reversing the asset that I've created. So that is the only way by which I'm going to recover it. So I should be prudent enough to say that I should be prudent enough to check whether this is reversible in the future. Then if I am creating on account of unabsorbed losses or carry forward of losses. So unabsorbed losses where I have a loss in the current year, carry forward losses that is originating account of the future. I should keep in mind that I have a virtual certainty where there is a convincing evidence. Having certain POs or not the convincing evidence that the standard is talking about, we should have a convincing evidence that this particular losses will get absorbed. If we don't have a convincing evidence in a particular year, it is critical that we postpone that particular recognition of deferred tax asset. So to give you an example, let us say a new hospital has been floated. So there is a new company which has constructed a hospital, and as per the business plan of the hospital, and by eventual market study and etc., we know that a particular hospital starts making profits only after the 5 years. So first 3-4 years you are ending up with losses. Now in the first year, whenever I have a loss, I have to evaluate whether in this year it is prudent to create a deferred tax asset or not. No, they might have certain, let us say in this case, I review whether what is their occupancy levels, whether occupancy levels are improving. I review and look at whether, their profitabilities are increasing and etc. Gross level profitabilities are increasing, whether their losses are pure admin losses or at cost, at a prime cost losses. I evaluate all these factors for a couple of years, 1, 2, 3, and I feel that there is an improvement in the trend, and eventually by their business plan and by their evaluations and by the trend of what is happening out, there is a probability, there is a virtual certainty that it will get reversed. Then I will create a deferred tax asset. In the absence of it, I will not create a deferred tax asset and eventually have continue with not to have a deferred tax asset. So this is a very important element, because in India this virtual certainty is not established. It is only reasonable certainty. But here, with respect to losses, we need to have a virtual certainty. So just having a couple of POs may not be considered as a virtual certainty. So reasonable certainty is examination of past records, like I have POs, certain estimates of the profits is what we would call it as reasonable certainty. Virtual certainty is matter of judgment. It cannot be, it depends on a case to case basis. But like for example, let us take an example that I am at the near end, and I see that I have evaluated them for 2 years. Every 2 years there is an improvement on account of the past records which are evidencing, and they have, at the time of audits, I would have had certain months that is already passed. Let us say for the March close, I'm doing an audit in July or August, which means that I can evaluate what is the performance in these last periods. All that would be my matter of concern and matter of evaluation whenever I see losses. One good example is that, let us say an entity moves from depreciation loss to a book loss mode, from a book loss to a depreciation loss level, which is a very clear evidencing point that there is a virtual certainty that they will start making profits. So these are some of the examples that I can think of. It is not just mere PO. So I mean, the concept is we have to evaluate the case and be sure that they will have profits in the future, and then only create deferred tax asset on account of losses in the primary element. And with respect to unrecognized deferred tax losses, now let us take a example here. What we mean by unrecognized deferred tax losses. Let us say year 1 profits. I'm just assuming for a moment this entity has a very low or a negligible so I have a profit of -100, which means my carry forward losses in this case it is 100. Let's say now I evaluate, or I'll put it as -5. Now in the first year, I don't have a virtual certainty that this company is making profits. So I would just compute what would be the possible deferred tax asset which is, say, assuming the tax rate is 20%, so my deferred tax asset is going to be 20. 30. Here, when I say unrecognized deferred tax losses, here I have not recognized it. In global standard, we call it as valuation allowance. I am not creating any deferred tax asset. So these are deferred tax asset computation, recognized, unrecognized. So recognized is 0, unrecognized is 20. Next year also I evaluate. So at a closing tax level, I have a 30. I don't have a virtual certainty, so I say that I'm not going to recover it. I'm not going to recognize 30. Now they have a carry forward losses of 200, and now I am not going to recognize it. The next year they have 41. This is a year where I see a convincing trend that the losses are getting reduced, and I'm having a virtual certainty that I'm going to create a deferred tax asset. The question in front of us is, they have a carry forward losses of 205. Now in India, assuming this is not a depreciation loss, you have an 8-year window. Now out of this 205, I am not sure whether they will absorb and they will utilize all their carry forward losses. I evaluate their business plans and etc. Their business plan is talking about having a profit of next 5 years, where they are having a utility of losses in next 8 years. Let us say to the tune of 150. So first year I started making profit. I review their business plans in eventuality, and just not reviewing the business plan, I also look at, let us say they're making profits at 20. So if I have to have another, so I can have another 3-year window to utilize this losses, 7, 8, and I should eventually make 20 profit. In next 3 years, I should make a profit of 80 divided by 3 on an approximate level. Eventually, I have to make profitability at this level, even to absorb this first year losses, because before that it gets exhausted. Now, I believe that I am not too certain at the year 4 that they might be in a position to use their 100. Based on the business plan evaluation, looking at the documents, how much is that they can utilize, I believe that they might be in a position to exhaust only 150 as out of their carry forward losses for the utilization, which means that I will not create deferred tax for 41. I will create only to the tune of 30. So this is very important. Whenever we have a deferred tax losses, whenever you have a losses to be carried forward in the current year or on account of the previous year, it is not required for me to say that I have to create deferred tax asset for full or zero. It's not the case. The standard actually allows us to make an estimate on how much of the losses will get absorbed, and I can create deferred tax asset to that extent that you believe that it can be realized. So only the term that is used is unrecognized deferred tax losses. You get my point. So unrecognized deferred tax losses is 11 here. So what I will do is, every year I will evaluate whether this 11 is to be moved to deferred tax or not moved to deferred tax. So in the next year, let us, for an assumption, believe that they have made some profits, which means that they are going to utilize some of these losses. So I have to remove that or reverse it. So my closing is going to be on this, which is 20%. Okay, and I might have to reverse a few element about it. 37. I've already recognized 11. So let us take utilization. So which means that this 20 is used. So I might have to reverse that 24. So now my question is, if they are in a position to use their entire losses, which I believe that they can, then I might recognize for this 33, and my unrecognized is going to be 0. So I might create it for 33, but I believe no, out of that 185 they might not use it in full. Anyway, this 4 has to be absorbed. So I might still say that, let us say for 20 or for 50 rupees, they might not be in a position to use their losses. That losses is going to be eventually lost, is my view. So which means that I should carry a closing of 10 here as unrecognized, and this I'll make it as a balancing figure. I might want this number to be 10. So which means I will restrict this to a number by which I have a closing of 20, and I want unrecognized this portion to be 27, so that to have it as 20. So I have 31. Oh, this total. So I have total deferred tax that I can generate as 10. I have recognized 10 minus 14 I have. So unrecognized portion is going to be 27. So if I'm going to increase it by, let us say 27 is eventually something that I don't want to have as a deferred tax asset. So which means that the concept here to take home is I might have to evaluate every period, every now and then, what is that particular losses that I am utilizing out of that particular eventuality in such a way that I might don't need to have a an approach or a reason where I don't have the losses to be utilized, or the losses will get exhausted, but I'm carrying a deferred tax asset. That should not be the case. So every year, whatever is unrecognized, I will evaluate and check whether I might need it or I might not need it to be created. I hope this makes sense. So here the closing balance is going to be 30 plus 4 and minus 4, which is 40, and they are carrying forward a loss of 185, and out of that 50 I believe that they are not going to use, so which means that 135. So if I divide this by this, I eventually get that percentage approximate. So I should keep that in mind whenever I have that deferred tax principles on board. I hope everyone of us are in same page in this concept. So if you have any doubts or any questions, you can keep it open when we do this end of the session. So current tax is to be measured to be paid on applicable tax rate. Deferred tax asset should be measured or enacted on substantively enacted by the balance sheet date. So far, all of the examples that you have seen, we have assumed that, okay, here in this case, we are putting it at 20%. So how does we arrive at this 20%? What is the tax rate that we should adopt? So tax rate that we should adopt will be the tax rate enacted and substantively enacted. So let us take an example that there is a budget that has come into picture, and let us say in the month of February, and the tax rates for corporate is reduced. Now you expect that your client might take uh, a lower tax rate because he doesn't carry a lot of allowances or etc. Not in case of deferred tax losses, but eventually whenever you have a deferred tax example and you are thinking what is the rate that I should adopt, the question is, the budget has come, there is a lower tax rate that has been enacted, it is just pending for president signature, but we should use that rate and not the past rate when we are creating deferred tax assets. When it comes to current taxes, you will use the rate that is applicable for that assessment year. But when it comes to deferred taxes, you would use tax rate that are enacted or substantively enacted, which means that it is just waiting for the signature of the president, something like that. That will be the rate that we use. Any reason for it? Any of the attendees have a specific reason for it? Any reason why we have to use the rate? We have to use the rate which is that is substantively enacted. Any reasons? Exactly. So one of the users are saying it is future. The concept is, whenever I create a deferred tax asset or a deferred tax liability, I know that it is going to be reversed in the future. So which means that whenever I am going to reverse it, it is going to have a different tax rate than the rate that I'm going to have today. So let us say this is something that commonly happens in, I have been a consultant for an entity where I used to have computed deferred tax as an auditor for quite some years, and they have all combinations, like they have leases and eventuality of leases on deferred taxes. They have they are having 43B, they have gratuity, they have leave encashment, whatever you have. This a textbook example for a deferred tax problem. Now, in this case, I think one user is saying the rate should be used to be realistic and rebuttable. Fair enough. So now, fundamentally, what happens is that, let us take an example. I have a deferred tax impact on account of WDV difference in every year. Let us say first year I had 100, and let us say second year I had 50. Third year I had, let us say, 20. Now, whenever I create deferred tax assets, so tax rate, let us take 20. The first year, I believe the entity didn't have a lot of they didn't have surcharges, they didn't have any of that. So this is 20%. Now in the year 2, their income grew substantially. They had surcharge. They started having rates where that will be more than what was there in that particular period. Now, invariably, what would happen is that people would not be aware that it is created at 20% and reversal happens at 25%. All that, people don't keep an eye on it. So that's what most of the time happens. So we reverse more than what is required for us to be passed on or something like that. So let us say the tax rate is 25. Now what happens here is you have an asset or a liability at this level. One more reason why we have to use WDV approach rather than income approach is that when you use this rate, you are actually costing it for the future. Now when we reverse 35, let us say enacted tax rate is 25 and substantively enacted tax rate is 27, just assuming. Now if you pass at an enacted tax rate which is 20, when you have a substantively enacted tax rate of 27, in third year you would have passed deferred tax asset for 25, but you reverse for 27. It would eventually happen for this 20 to 25 also, but this is not in our control. And for the moment, we'll assume substantively enacted is also 20. This is not in our control, but this is in our control, right? So because it is of the future, as one of the listeners have told me, one is that it is of the future. Second is, when it is getting reversed, it is also going to get reversed, or it is going to be passed only when at a newer rate. So we should keep that in mind, that this is what going to eventually happen on differential rate. See, this might not be very significant when you have the stamps, they are in the same taxation buckets. Now assuming you have surcharges, so they add surcharges and then they are having a higher tax rate, this becomes an eventual problem. So in practice, how to solve that is two ways. One, with respect to substantively enacted rates, we use whatever is there in the act. If a client is neither there, whether the client is there with surcharge or not with surcharge, it is better that we use rates that are with surcharges. So it is just I'm not saying this is what there in the standard. This is an approach that I use and I recommend to most of my clients, is that uniformity of rates would more or less be enabled. I'll give you a reason for it. Now let us say first year they didn't have a surcharge. You would have put it at, say, 30%. And next year, let us say they have a surcharge. So actual the rate is, let us say they are in 12% surcharge. So the rate is going to be 112%. Just for a moment, let us assume. So it is 34 as against 31. Now assuming you have passed on a percentage at, you have passed on it at 31%. And you reverse it at 34, we are causing a 3 difference. And when we have an entity which is into a surcharge, you're talking about a large scale of income, which means that inadvertently we're making an error in the financial statement without even being aware of it. So I generally adopt this practice, whether a client is in surcharge, not with a surcharge, because in future he might go to a surcharge, because you cannot keep a tap on which year he had surcharge, which year he didn't have a surcharge. All that is going to create complications. So I generally make it as a policy that whenever I create deferred tax, I create it at a rate including surcharge, even if the client is not at surcharge state. This is one of the practical tips that I've been using, so that you'll have uniform approach on creating deferred tax asset. You don't know which rate someone has adopted, all that complications you can avoid. Second, you should not create deferred tax asset on MAT rates. MAT is an exempted rate that is available for an entity inside the tax act. It is not the tax rate of that entity, so it is going to be a different norm. So we are going to create it only on the tax rate. So it is going to be on normal tax rate. So it is on applicable tax rate and tax loss. and it is going to be substantively enacted. And deferred tax and asset should not be discounted to its present value, because you don't know when it will get realized. It is always at the present value. Now, there are two things here. One, we saw that we are going to create deferred tax asset or liability with an assumption or with an indication whether it will get reversed in the future. That was point one. The second point that we were trying to make over was that now, whenever there is an unrecognized deferred tax assets, I am going to evaluate it on a periodic basis to know whether that has to be reversed or not going to be reversed. That was the second point that we were talking about. And I will evaluate it on a periodic basis because I need a virtual certainty on deferred taxes. The third, let us assume that I have created a deferred tax asset in the past. I had virtual certainty at that point in time. Now, I have a scenario that the assumptions with which I have created deferred tax asset is no longer relevant. So I'll give you an example. We'll just extend this example. So I am in year 3. I believe that, or I had computed that they are going to have the entire tax loss. So which means that I have created deferred tax asset for 40, which means that I've created for the entire value. There is no unrecognized portion. Now, what the standard is asking us to do is, I have created, so now I'm coming to year 4. In year 4, I evaluate their business opportunity, their business plans, and etc. And I determine that they might not be utilizing their entire tax assets that they have for reversals or for utilizations. Their business plan is not supporting it, or etc. The standard is saying it's not an error because that time it was done with certain assumptions. Now the assumptions are changing on account of business practices or etc. The standard is allowing us to say that in the next year, my closing deferred tax should not be 40, and assuming for a moment that we believe that they can utilize only 150 out of their tax loss of 200 that is available. 20%, yeah, 20%. So which is 30. So the standard says it is okay if I say that they are going to use only 10. I mean, they're going to use only 30 and reverse 10 that is already being created. So this is called evaluation of deferred tax asset that was originally been there. Clear on this? So the conceptual framework here is that it is not that once I have created a deferred tax asset, it is perennially should be kept it at that level. It's not that it's like once it is done, it cannot be, it is frozen or it is sacrosanct. Not like that. So it means that if there are certain assumptions at a later point in time which is enabling me to reverse or requiring me to reassess the position, we are allowed to do it. To put it in a better way, we are required to do it, which means that every year after I do the computation of deferred tax and etc., I believe that this is a deferred tax asset. So I generally take this approach on a practice. So what I do is, let us take that I have done all my computation on deferred taxes like leave encashment, gratuity, and losses, etc. Whenever I have a leave encashment and gratuity and I also create on losses, I will ensure that to the extent I don't recreate it. I will not have 2 times approach, because you are going to create deferred tax losses on income tax losses, not on book losses. So when you compute income tax losses, which means that you've already created for leave encashment as well. So now I have a disallowance in leave encashment for which I have created a losses. I will ensure that the losses is circumventing that. It should not be a dual approach. So we should keep that in mind. We should create it post the disallowance, is not in prior. Now I have, is there a question? Okay. No, will this change in assumption mark the quality of change in plan? Actually, it is relevant to the circumstances that we're talking about, because see, it's not that every change that we're talking about is purely on account of an error. It could be a real reason that that there is a plan that gets changed. Let us take an example of what was there in the Steepermudur plant in Nokia. So it is not that it's a global policy that Nokia took that they are going to go out of business of their particular mobile division. So it could have an impact that one of my predominant customer who was giving me a lot of orders has gone bankrupt. I have not planned for that. So the question is this change in evaluation or change in assumption, it is a problem of error, or it is actually a problem of, the real assumption changes is to be evaluated on a case-to-case basis. It is not that it will always be a problem of, I'll explain that. It is not a problem of, it is a problem of error, or it is a genuine business problem, is something that we have to evaluate on a case-to-case basis. I'll explain leave encashment, how to that get created. Now I have created all these deferred tax assets. Let us take the total of all this, 10, 10, say 30. So which is 50. Now the question in front of me is, I have created out of those 50, 20%, which is 10. So eventually, when I evaluated in the balance sheet level, I would have done an independent evaluation whenever I create for leave encashment, gratuity, for losses, everything. I have made an independent calculations. Having done that, still, when I am carrying a deferred tax value of 10, I will just do a very simple estimate of this divided by 20, which means you don't actually happen it that way. So let us say the closing is 10, because you don't have it. You don't have it at when you do a calculation level only, you'll know the breakup. But I look at it from a balance sheet level. So if I'm reviewing a financial statement, I say that they're carrying a deferred tax asset of 10. I divide it by the taxable profit, which means that I will just keep in mind and evaluate whether they will have this 50 in the future to be recovered or not. You have to keep that in mind. That is what the standard is expecting us to do on evaluating the balances of deferred tax asset on a year-on-year basis. And we feel that it may not be relevant to keep that much of an asset, write down or reducing the asset balance is an allowed practice on the accounting standard perspective. On leave encashment, how to create. So let us start from year 1. You are providing inside your books for leave encashment, let us say 20. Now, as per the Income Tax Act, the allowed portion is only 10, because that is the item that is paid. So you will create a deferred tax for 10. Year 1 is always simple, because you're starting at a bare minimum, there was not opening and etc. Now the second year, what happens is you create a further provision. So these I'm talking about closing liability. Allowed and difference. The next year, what happens is in year 2, I have a closing of 20. I might provide for another 5, which is 25, and I am allowing 5. Now, when I create a deferred tax asset, I should keep in mind that I'm creating again at a closing balance level. So this is what in income tax IFRS is it's called my tax assets. So I'll draw down like this. What is my, it is always at an asset level. So I compute something called as a deferred tax. I mean, I'll call something as a tax asset. So now let us take leave encashment. In leave encashment under an IFRS approach, I have books. The liability that I carry in the books is 20. When it comes to taxation, the liability I carry is not 20, it will be 10, because I'm allowing only 10, right? In the next year, let us say I'm providing for 5 more, my closing balance cumulatively is 25, and here let us say there are a lot of people who have taken in base, my tax base for leave encashment would be more, because I've allowed 10, now I'm allowing another 5, so which means my tax base is cumulatively 15. So here, when I have a closing of 25, I have allowed 5. I have to keep in mind, if I compute this difference of 20, let us take 20%. Let's take 20%. This difference is a P&L charge. And this is not my P&L charge. Because in books, I am having a, if you are doing an income approach, 15 and say, sorry, 5. And what would happen is you are providing 5, you would have paid, or you're providing 10, you have paid 5. This is the movement in that particular account: opening, addition, and payment, and closing. So in income tax, you're allowed only 5. So I should be, if I'm doing a P&L approach, I should keep in mind I'm only creating for 5. 20%. If I'm using a balance sheet approach, I should keep in mind that if I'm using a P&L approach, I'll create only for 5. If I'm using a balance sheet approach, I will say that I had allowed, so there is no opening concept in income tax. So this is the payment, and I am creating a deferred tax asset for 20%. If I am going to use it at a closing level, I should keep in mind that I would have originally allowed in the last year, let us say 10 was allowed. 10 was allowed in the IT Act. So which means that I have creating a deferred tax charge for the previous. So which will be, because this is the first year, I don't have any other impact. It will be 2. Now I am further creating 1. I should check whether I am disallowing this 2. I have an addition of 10, which is getting disallowed. Payment of 5 is allowed. So I have cumulatively allowed how much? Oh, sorry. I have cumulatively allowed earlier 10 and here 5. So which is 15. So I should always keep in mind that my deferred tax is in that region of 2. Yeah, will it be different using income approach? So first I'll explain this part, then we'll come to that particular question. So here I should keep in mind what is my closing charge and what is my current P&L charge. So that, you know, that clarity that I need to maintain. So a very easy or a realistic approach is you see what is your closing as per books, which is, let us say, 20. And what I am allowing in the current year, I have allowed in the past certain items. If I have a track record of it, I create a, you know, a repository kind of a thing. Like for example, I have had an opening of 0, I allowed 10. Now I am adding 10 here. This is not getting allowed. Payment of 5 is allowed. So I have allowed 15. So which means that at a closing level, I can create deferred tax only to the tune of 10. Now here, if the payment is, let us say, instead of 5, it is 7, I am going to allow current year 7. So which means that I have allowed till now 17. My asset, closing asset, should carry a balance of only deferred tax on account of 6. So this is something that we should keep in mind whenever we are creating a deferred tax asset. The ideal point here is we need not do an overkill where you didn't create a deferred tax asset in the past and then currently on allowances you are creating a deferred tax asset. That should not be the case that we are talking about. Okay. So there was one question on if I am using an income approach towards these deferred tax assets and I am going to create deferred tax losses on account of property, plant and equipment, how do I do, or how do I deal with it? That is exact item that I am telling about, not as an overkill. Now let us assume, let us take an example of leave encashment, gratuity, property, plant and equipment, which is your fixed assets, and then losses. Now if I use an income approach or I use a WDV approach, irrespective of whatever approaches that I do, a component of my depreciation losses has actually been considered when I'm computing deferred tax asset at this line item level. Am I right? It is already been considered. So I should not, you know, end up creating on the unabsorbed depreciation losses as well, and also not on my book losses as well. I mean, I should not create depreciation loss impact in property, plant and equipment, and also on my unabsorbed losses. It is a dual approach. Okay, let us take income approach, which is very simple one, which we have already created an example. Let us take this example. where we will use income approach. So now I have created a deferred tax lineage, so which means from 354 or for the simplicity, I am going to say it is going to be observed over 5 years, just to be on a simple note. So which is 100 in income tax, to be a little simplistic. So now I have a deferred tax asset or a P&L on account of depreciation. Now let us say this company is under losses. The business loss say minus 70, or let us take the losses, that example that we had here. Now they start making profit in the 5th year. Now depreciation loss, I know depreciation loss is going to be this much. So assuming for a moment they still have a depreciation loss. When I create deferred tax asset, I have already considered deferred tax asset on account of my depreciation at this level. I should not rework at this level as well. I would create it only on business losses, because this timing difference, even when you have a depreciation loss, which you are going to utilize it, here when I have considered that particular item, I will not consider it here because it becomes a dual approach. Correct? At any eventuality, whenever I use this losses as well, the depreciation is already claimed. Because you couldn't claim it in this current year, you are postponing it to your next year, which is what is unabsorbed depreciation. But for deferred tax purposes under WDV or an income approach, I have already considered it. So I will not consider it again here. I will use only at this level on losses. I will have to keep in mind that same item is not considered for deferred taxes twice. I hope I have answered the question of everyone. If you have any questions, you can still post. Is this question answered? Okay, coming back. Okay, so on timing difference using asset approach, whatever is that approach, will it be different? The question is that asset approach or an income approach, if I have computed deferred tax asset for depreciation under a pretext, I should not use it again for my losses and do it twice. So you should keep that in mind. So that's the point. So then offsetting. So this may not be a case where you have you've seen that in a very significant or an everyday basis, that let us say you have a foreign branch or an entity where you prepare it at a consolidated financial statement, and you have a couple of subsidiaries in abroad, and you consolidate them also when you are preparing the financial statements. Now what would happen is that you have a deferred tax asset on account of your Indian operations. You might have a deferred tax liability on account of your foreign operations. Now when we are presenting it, we are not allowed to say, let us say deferred tax asset is 100 and deferred tax liability is 50 between Indian and foreign operations. We cannot say our deferred tax net asset is 50. It's not allowed. It is allowed to be set off only when you have a legal point by which this can be offset against that. Ideally, for paying this 50 of deferred tax liability, which will become a liability in the future, I can use this 100, which is my deferred tax asset, then I can set it off. If I cannot use that particular asset for pre-paying my liability, then I'm not allowed to use it. So in my balance sheet, I will say that 100 as my deferred tax asset and 50 as my deferred tax liability. I will say both. You get it? It is to be under the same governing tax laws. It cannot be different taxation laws or different entities, jurisdictions by which you charge it. So in US, it's very common that you have a federal tax and you also have a state tax. So now if you have a deferred tax asset on account of a state tax and you have a deferred tax liability on account of a federal tax, you cannot set it off both because these are not offsetting against each other. Clear? So certain disclosures that you should keep in mind is that we should breakup of major components have to be disclosed, and etc. There are certain practical items that I have already considered, but I don't know whether I'll have enough time to cover another standard. So I give it two ways. One is we do this very well, or get an intro on AS17 as well. But I would prefer to do this well and keep an open on questions and connect back on 17 some other time also, because we are also running out of time, and it is better to do one standard very well than doing it at a 2 level. So we'll talk about ICAI, one of the very interesting concept on deferred taxes. I have a question. Continue with 22 only. So I had exhaustively worked on an entity which is using certain deductions under ICAI and other aspects, which is including FTWZ and other aspects about it. The standard is brilliantly drafted with respect to that particular item on any tax holidays. So we'll keep, if you are having a situation on creating deferred tax asset on account of tax holidays, how are we going to handle it? Let us take, there is a tax holiday, an entity is enjoying tax holiday for a period of 5 years. Year 1, year 2, year 5. The standard says, I'll first read what the standard is going to tell us about, and then deferred tax to be recognized on timing differences arising during the tax holiday period, but which reverse during the tax holiday period, reverse after tax holiday period. So what is that we are going to do? The standard is very clear that timing differences which reverse during the tax holiday period don't recognize deferred tax. Timing differences which reverse after tax holiday period recognize to the extent which in the year in which timing differences originate. So it is very clear, but unfortunately the way that the standard is drafted, it looks as if that it is complicated in another aspect, but the conceptually it is very simple, is that if a timing difference reverse within the tax holiday period, don't reverse it, don't create deferred taxes. If the timing difference is going to reverse after the tax holiday period, whether it is generated in any period, recognize deferred tax in the year in which timing differences originate, subject to considered of prudence. So now let us take, we are in year 1. These are the years. Let us take the company is in tax holiday period. I have a couple of questions. What should be the treatment MAT credit India? What is the treatment of MAT credit under US tax? Okay, I'll come to that. Okay, so that is a very simple question. MAT credit under IFRS is an asset under deferred tax asset itself. Under IFRS, it is an Ind AS 12. It is a deferred tax asset. So whenever you have an asset on account of MAT, I mean the MAT entitlement credit, it is a deferred tax asset. So which means that you are paying. So in our example, in one of the example we saw that, let us take this example. Now what I would do is, if I am doing Indian accounting standards, that is Ind AS, my profit will be this. My taxation impact, I will say it is net of this, because MAT I will classify under deferred tax. But under AS22, this is not this MAT difference is something that is originating because of differences between taxation laws, and not between differences between taxation laws and accounting laws. MAT is also a provision under Income Tax Act. Normal tax is also a provision under Income Tax Act. So the differences between those two are matter of tax acts and not a matter of an accounting difference and taxation difference. So AS22 says MAT differences that you get, either MAT entitlement credits or not your taxation profits, are kept out. It is other assets. It's not a tax asset. So let us come back to our tax holiday example. WDV is an easiest example to keep. Companies Act. And let us say Income Tax Act. You are having a tax holiday window, which means that you need not pay tax on during this period. That's a fundamental concept. Oh, sir. Now, when I compute this, a fundamental point that I have to keep in mind is I start estimating on year 1 what will be my Companies Act WDV at the year end of 5. How do I do that? I assume there are no tax additions, there are no addition of asset. Whatever assets that I have today, and I am enjoying a 5-year period of tax holiday period, from this date to that date, I assume there are no tax asset addition, right? And what would be my WDV as per Companies Act at the end of that period? That is something that I will first compute. So I will assume there are no additions. I will start with base today and say that assuming there are no other additions, I will have constantly be charging depreciation, and what would be my asset at that point in time. No, now I also do the same for Companies Act practices. Today, let us assume that my liability is 120. Okay, which means that I am charging more depreciation. I'll assume that it is 75 for a specific reason that I'll tell you a little later. So here I am charging more depreciation, which means that I am paying less tax and I will have a deferred tax liability. Because it is more on conceptual framework, I'm not going into the details of what will be, when will be a liability, when will have an asset. I think listeners would know that. So this is a difference. Now I am assuming that this is going to be 50, this is going to be 30, this is going to be 25, and this is, let us say, going to be 10. So the difference between these 4 are my differences. So year 1, in every point in time across all the periods, my Companies Act is more than my Income Tax Act, which means that I am ending up in a deferred tax liability scenario, DTL. Every time it will be a DTL, except for 1 year. Every year it will be a DTL concept, but here what happens is again I am having an increase, and again I'm having an increase. So 25 is my difference in the first year, 40 is a difference in the second year, 50 is a difference in the third year. I have a difference in the subsequent year, which is 50. Every year I have a DTL. Actually, these are closing balances. Now, this DTL is constantly increasing. This DTL is constantly increasing. You see that the DTL is increasing. It is becoming 20. So everywhere I have used the same formula. DTL is constantly increasing. The question is, do I have to create DTL for 5 or 10 or 0? Because you have a tax holiday period, you are not going to pay tax for those 5 periods. Question in front of us is, do I have to create deferred tax asset on this or not? The standard is saying you have a timing difference here. You see a pattern everywhere the deferred tax asset is increasing, a liability is increasing. If the liability that gets originated in 1 year, I'll go back to the standard term, the liability, the timing difference, if it gets reversed during the tax holiday period, then do not recognize deferred tax. If the timing difference reverse after tax holiday period, whether originated in tax holiday period or before that, recognize deferred tax in the year in which timing originate. That is, I'm in year 1, the 5 is on a constant increase, I will recognize deferred tax asset to the tune of 5 because the timing difference that gets originated during this period, which is 5, is not getting reversed within the tax holiday period, because the last timing difference is how much? 10. If it gets reversed, it will become less than 10. Correct? Correct. If my timing difference is going to get reversed, let us take an example. In a scenario where this year the WDV is 10 and this becomes 0. or a flip case where, so I have to charge the P&L difference. So I have 0 income tax now, and I might have another couple of years by which I might have the liability. So here I am charging 60. So let us take an example in 1 year, or the way that it plays around, because the Income Tax Act is little bit on the lower side. The way it plays around is that, so I'll take an example. Like, now I have flipped the example. Here, the timing difference that originate in first year gets reversed at the end of tax holiday period. It might happen because your income tax depreciation is on a WDV, your books companies act depreciation is on an SLM. It can also be on account of a scenario where your rates are different. It can be on account of various reasons. If I have seen both the cases, so that's the reason why I'm telling it is possible. If it reverse, here it is reversing. It is reversing. Then the standard says you create deferred tax only to the tune of 4. You don't create for the differences where the timing difference get reversed. When I recognize 5, it becomes 4 at the end of the period. So I will not recognize for 1 because that difference get reversed after the tax holiday period, at the end of the tax holiday period. Now let us take the same example and just flip the numbers a bit. $60, $55, $45. Let's keep it at 25. Here it's not getting reversed. Then you are going to create deferred tax on 5 in year 1. I mean, all this is going to happen in year 1, not on year 5. You're going to create deferred tax on 5 and not on 4 or not on 7, because you will go back to that year and check whether 7 is really happening, because you have to do this exercise on the entire tax holiday period. Clear on that? Getting it? So I'll go back to the verbatim of the standard. It says if timing reverse differences with reverse, do not recognize deferred taxes to that reversal. It's not that you don't stop, you stop doing deferred taxes. It is that you don't reverse it. But if that is getting created at a subsequent period, if there is a reversal that happens after that, here during the tax holiday period there is no reversal, then recognize the deferred tax in a year in which timing difference originate, which is 5. It is originating in year 1, so I'm going to create a deferred tax asset or deferred tax liability. Clear till now? Clear on this? Or you want some of the listeners wants me to repeat? Clear? Clear on this? Okay, so loss on the hit capital gain, income under capital gain do not arise on account of normal activity. So you might have to keep in mind. So I would have, when you recognize an asset on capital gains, whatever losses that you have to keep it in mind on virtual certainty that it will happen in the future. And 10A is also something that we have already said. 10A or 80IA, whatever is the tax holiday period, however it's going to happen. So this is tax rate is a subjectable event. So this we have discussed, and I think these would not be possible for us to close in another 5-10 minutes. So yeah, I would close it off at this level on the session, because amalgamation and certain concept, if we discuss now, it will be a little too much on that particular screen. So if you have any doubts, I'm open for that.
1 minute, sir. I hope you have answered all the queries in the live chat box itself, right, sir? 1 minute.
But
Sir.
if you have still anything, I'm open for it for a couple.
Yeah, I will wait for 1 or 2 minutes.
Any queries? Any questions?
We'll just wait for 1 or 2 minutes.
Yeah, sure. how do you recognize deferred tax in year 1 in case tax holiday? You mean the applicable tax at year 1? Yeah. Whatever is the tax at that year, so which will be 20% or 25%, which is enacted that period. Because tax holiday period, tax rate doesn't change. It is that during that period you are not going to pay tax for that business. That's the concept. Even if that is 4, you don't know what would be the tax rate after 5 years. No, it will be on the current rate that you will charge. That is all. Thank you everyone for your wonderful time. I hope you enjoyed the session. Thanks SIRC for the opportunity. I hope I'll connect another time to connect on AS17. This was interesting, and listeners also wanted to keep this on 22, so I continue with that. Thanks SIRC once again. Thanks to the listeners for listening. Keeping it interactive was more fun.
Thank you very much, sir, for your time, and your explanation was so lucid with the small examples that it was making the points very clear. Even though I was not 100% present in this, this one I could guess, and I could understand that it was very lucid presentation, and even for the newcomers, beginners also, it was very easy to understand. I think I'm afraid you could not find time for AS22. So we will meet up some other time. Thank you very much for your time and your concern for this institute. Thank you all the participants for making this webinar very useful and purposeful during this year-end time, despite the year-end busy. Thank you for attending this program. I thank the chairman and secretary for choosing this topic for the day, and also the back office of SIRC, and special thanks to Mr. Selva. Thank you all. Good day.
Thank you.
Good night.
Thank you, sir.